Hi, this is John McRobert at the Zamseed Yield Improvement Center, and I'd like to talk to you about profit in farming. In order to do this, we need to think about the business model that a farm would have. And when we think about farming as a business, we obviously begin, I think, with considering profit. We're in farming to make a profit. Now, profit is not the only thing that we're interested in. And profit must be part of our general vision for the farm, which would include environmental issues and social issues, as well as the financial. But if we're going to be farming in a sustainable and a growing way, in other words, our business is going to continue to grow, we need to have a profit focus. But what do we need profit for? Profit is obviously what is required to sustain the business and to enable the business to grow. But when we think about having a profit, the first call on profit is the government. We have to pay tax on our profit. And then once we've paid that tax, we can consider other uses for that profit. These are some of the uses you could use that profit for. You could reinvest it in the farm, in land development, purchasing land, developing your land infrastructure. You could buy machinery that you need, and you might use that for working capital as you grow your business. You might also use your profit to pay off any debt that you have faster than required. You could invest that profit into new enterprises, either on the farm or off the farm. So on the farm, you could expand the kinds of enterprises that you've got, starting new ones. Or you might look at a business opportunity off the farm and use that profit to invest in that business. You could also just keep that profit as a cash reserve. You could also use that profit to pay your shareholders, and you might even be willing to give away some of your profit. So you could apportion your profit between these things or on one of them. So we come back to this. We have a profit goal for our business. And that's what must drive our business, this profit goal. But how do you get to profit? Well, the first thing you need is income. That is what's going to determine total income that you have and the profit that you can get from that total income. But to achieve an income, you have to produce and sell something. And the production of that something is going to cost you. And this is what we call variable costs. So if you have 10 chickens, it's going to cost you a certain amount of money to produce those chickens. If you have 100 chickens, it's going to cost you more. 1,000 chickens, it's going to cost you more. And that variable cost varies in proportion to the amount that you produce. It's all those direct costs that go into producing the thing that you're going to sell. And the income then is going to be the number or the amount of product that you sell multiplied by the price. And the variable costs are related to the number of units that you produce, the number of hectares in a cropping scenario, the number of animals in a livestock scenario. Now, the income minus the variable costs gives you your gross margin. And the gross margin is that proportion of your income that is now in excess of what you spent on your variable costs. But you have to run your business. And when you're running your business, you have administration costs. You have people who do things that are not necessarily directly related to the production of your goods. They are managing your stocks, the clerks, the accountants, the people who do things in and around the business every day of the year. And they may not be directly involved in the production of certain products. You have to have marketing. Marketing is perhaps one of the things which many farmers don't spend a lot of money on. Obviously, it depends on where you sell your product. But the more you direct sell to customers, the better you have to be at marketing. And then there's all the overhead costs like rent, electricity, licenses, repairs and maintenance. All these three things, administration, marketing, and other overhead costs, are what we might call operational costs. Some people call them overheads. Now, the gross margin minus the operational costs gives you your gross profit. Now, what are the proportions of these things? Now, as a general rule of thumb in farming, we expect our gross margin to be 50% of our income. If that's the case, then our variable costs are 50% of our income, and the gross margin is 50% of the income. Operational costs shouldn't be, generally speaking, more than 30% of your income. So that if you add the 50% to 30%, and you take that away from 100%, you end up with 20%. Now, a gross profit percentage of 20% is something that you should be aiming at. Now, that's not a fixed figure. It could be anything from 10 to 30% of your income as being profit. But we need to think through these numbers and come to some objective goals that we aim at in terms of what our gross margin should be, what the maximum of our operational cost should be, and what our expected gross profit should be. Now let's look at the profit cycle. So remember, the whole point of this presentation is that we focus our farming business on achieving a profit. Now, we spoke about how you could use that profit. So at the beginning of each year, you need to think through, what do I need to spend my profit on? So how much profit do I need? And in this example, I've said $5,000 or 5,000 kwacha, whatever your unit of currency is. And we would like that profit to be 20% of our income. So that means that if we are aiming at a gross profit of 5,000 with a gross profit percentage of 20%, we need to have a total income of $25,000. So how do we calculate the total income from our profit? Now, total income equals gross profit divided by the gross profit percentage. So if we take our example of a gross profit of 5,000 and a gross profit percentage of 20%, then our total income is 5,000 divided by 0.2, which is $25,000. So that's what our total income should be. That's what we're going to aim at. So we need to produce enough product and sell it at a sufficient price to give us $25,000. Now, we are going to aim at a gross margin of 50% in the enterprises that we run. That means that 50% of that total income will be our gross margin, another 12,500. So 25,000 minus 12,500 is the total variable cost that we can spend on our enterprises to give us a gross margin of 12,500. Now, our gross margin of 12,500 less overheads of 7,500 will give us our profit of 5,000. So our maximum overheads are 7,500 if we want to achieve a profit of 5,000. So now, in a very simple way, we've defined the profit cycle. These are not set in stone, so to speak, but they give us a guideline of what we need to get in our total income, what we need to get in our gross margin, and the maximum we can spend on our overheads to give us $5,000 gross profit at 20% of income. Now, there's only two ways, basically, that you can increase your profit in this profit cycle. The one is to decrease your costs. Okay, and this is what this graph shows. If your gross income remains constant, in other words, you sell a certain number of chickens at a certain price, or you have a certain amount of maize or soybeans that you can sell at a certain price, the only way to increase your profit is to decrease your costs. And you have two major components of your cost. It's the variable costs of the enterprise and the overhead or operational costs. It's very difficult to reduce your variable costs and maintain your yields. You have to feed your chickens a certain amount of food to get them to a certain weight for the market. You have to apply a certain amount of inputs into your crops in order to get the yield that you need. So to save money or to decrease costs on variable costs is difficult. The only real way there is to improve your efficiencies of operation and your management of the system, so that you get the best return on the inputs that you apply. But there is opportunity generally to save money on your overhead costs. And again, this comes down to good management, reducing your repairs and maintenance costs through good management, getting the best deals on all the things that you need to operate your farm, managing the labor well, analyzing all the trips that you take, the rentals that you pay, the electricity that you use. Controlling those costs will help to improve or maintain your profit percentage. The other way, of course, is to increase your profit by increasing your gross margin within your cost structure. Now, the only way you can really increase your income in farming is to find a better price. Now, of course, you can increase your yield. Your yield is a function of your environment, your management, and the varieties that you use. So in a livestock enterprise, you want the best adapted cattle, you want to manage them the best you can, and you want to give them the best environment so that they produce the most amount of meat from your farm. Likewise with your chickens, whatever they are, layers or broilers, to increase the yield of egg production, to increase the rate of growth of your broilers and so on. So you increase your yield. But with yield, you also seem to reach a plateau. You have a maximum yield that you can attain on your farm. So the only other solution there is to find the best price for your product. And this is where farmers often have a problem, because prices are set by a market that you have very little control over. Either the government sets the price, or the middlemen set the price, or the off-takers set the price. But if you can find ways to increase that price through direct marketing, or through collective bargaining, or through timing of your sales at the time when prices are their best, then you can increase your income for your given cost structure. Then your profit will increase. So with those things in mind, we need to look at how we can apply this profit cycle into our enterprises. And this is where we will look at a spreadsheet that we have and that's available for you to use to interrogate these numbers in a more fluid, dynamic manner, to come up with a much better plan to achieve the profit that you need for your farm. Here we have an Excel spreadsheet of that profit cycle that we spoke about. Now you can see on here, you've got the gross profit over here, and that then leads to the total income, across to the total variable costs, gross margin percentage, and then up to our overheads. Now if we adjust these numbers to our example, we put 5,000 here and a profit of 20%. And if we put our gross margin here at 50%, the spreadsheet calculates those numbers that we looked at earlier. So our total income should be 25,000. Our total variable cost should be 12,500. Our gross margin will then be 12,500, giving us a gross margin percentage of 50%. And if our overheads are 7,500, the 12,500 gross margin minus the 7,500 will give us a profit of 5,000. And in this situation, the overheads represent 30% of our total income. That then gives us the general parameters of our profit model. Now, in the table below, we can now adjust or figure out how we are actually going to achieve a total income of 25,000 and how we can adjust or manage our crop to give us a total variable cost of 12,500. So let's look at that in a bit of detail. Okay, we have an option here of looking at a number of enterprises on the farm, but just for this exercise, we'll just use maize. So let's say we grow 20 hectares of maize. Okay, we put in the 20 hectares, and let's say we expect a yield of 5 ton a hectare, and we expect a price for that maize of $250 per ton. That'll give us a total income of $25,000. So we've achieved, in theory, our total income of $25,000. Now, what will be our variable cost per unit in order to achieve a total variable cost of $12,500? In this case, we can spend $625 per hectare on those 20 hectares, and that'll give us a total variable cost of $12,500. And because our price is giving us an income of $25,000, our gross margin is $12,500, which gives us a gross margin of 50%. Now, on this spreadsheet, it calculates also the break-even price. Yeah. So the break-even price is $200 a ton, and our break-even yield is 4 tons per hectare. So in other words, we cover our total costs if our price is $200 or if our yield is 4 tons per hectare. So our profit then is made on that last ton of yield or on the price above $200 in this scenario. So that then gives you these parameters that you can work on to figure out, is this feasible? Can you get 5 ton a hectare? Can you produce a crop at $625 per hectare? Will your price be $250 a ton? So as you look at these, you can play around with the spreadsheet and figure out, what can be done. For example, if you only get 4 ton a hectare, like you see, the gross margin goes down to 38%. Our total gross margin is $7,500, which only just covers our overheads, and therefore down here at the bottom, as you can see, if I adjust this sheet, if our overheads are $7,500 in this scenario, our gross profit is 0 and our percentage is 0. Now the other thing we need to consider is our overheads. So that comes up on this lower section of the spreadsheet. We can specify our overheads here and see if we can budget them within the $7,500 per year. So here I put salaries at $3,600, a little bit of money on marketing, a little bit of money on rental, electricity, transport, office costs, licenses. Now this might not be your scenario. You can add or subtract and adjust these in the spreadsheet. So these overheads categories may not be appropriate for your farm, and you can change them, adjust them according to your scenario. And remember, I said we also need to think about how we're going to use our profit, and this little section of the spreadsheet puts our budget on how we're going to use the profit that we'll get. So we intend to get a $5,000 profit. We have to pay tax there. We can't do anything about that. And I just said we'll keep $750 as a reserve, and we'll invest back into the farm $3,000. So that is a very simple spreadsheet that you can use to work backwards from your profit that you intend to achieve, back down now into what you must earn in income based on the enterprises that you run, in terms of the area or the number of animals, the yield that you expect, the price per unit, and then how you will pay for those enterprises in terms of the variable costs per unit. In this case, it's variable cost per area, so $625 for each hectare of production. But if it's layers, it would be per bird. If it is broilers, it would be per bird, and so on. And then you also get some idea of what your break-even price is and break-even yield. So this then helps you to formulate a budget and a plan for your farm to achieve a profit that you require to make your business sustainable and to grow. So thanks for watching. Bye for now.